Hi, we are AIO Financial. As you know me, I'm Alex Sanchez.
I'm Bill Holiday.
And today we're going to talk about a little situation happening a lot, a continuous question that we are getting from many clients relative about how the market is performing and what should they be doing. So here we are. Do you want to start with something, Bill?
Yeah, just a little background. We had COVID. We're up about 20% from pre-COVID. So if it was a straight line, that was about 3 years ago, which the market's making about 7% a year. So it hasn't been bad, but we had a huge dip at COVID. Really, tech stocks drove us higher. There was government bailouts and investments that pushed the market really high. And 2022, we saw a decline in the market, and a lot of that was a reaction to the Fed trying to control inflation. And so the market's down, and now we're in 2023, and we're dealing with the same thing. Inflation seems to be lower, but it's still high. The Fed's going to continue to increase interest rates. There are supply chain issues, gas prices, there's other issues pushing inflation up. But, the market it's since the beginning of 2022, the market's really been up and down, but on a downward slide. And we have a lot of people worried about that. Just how far more is it going to go? There's talks about a recession. Should we get out of the market and get back in when it's lower? What should we do? That's what we've been hearing.
Yeah, the typical questions. Yeah, but now that you said it was because of the tech sector that we started to recover after COVID, and I believe that right now the tech sector has been underperforming compared to that time. And to be honest, it came to a moment where people started that's the part on where diversification comes. Like, if you are the type of people that just invest on what the people are saying, or this is hot, this is where I should put my money on right now, that's when maybe you get a little bit of return back and you start feeling well with yourself. But then comes that part when out of the sudden the sector that you are currently most invested in are to underperform, then you start losing money. That's one of the main reasons, if not the main reason, on why we always suggest to diversify your portfolio, to just go for all sectors, or at least cover the most area that you need in order to, when this type of scenarios happen, don't lose a lot of money. And even if you do at least making money out of another sector that's starting to perform well. So yeah, there are pros and cons out of it, but if you have a real good strategy, you can at least don't fall too hard.
Yeah, I think that's a great point. Just have a financial plan and stick to it. Don't get distracted by the hot thing right now. We had a lot of people investing in tech during the COVID crisis, and rightfully so. There was a lot of hopes that tech people are just going to stay at home and use tech forever. And I guess getting overweighted in a sector isn't a smart long-term strategy. So we generally recommend stay broadly diversified and rebalance your portfolio. So and ride through these dips. Look at how much cash do you need, what cash flow do you need, and set up your portfolio so that you don't have to sell stocks in the next 5 years or 5 to 10 years, so that if there is a big dip, you can ride through it and be patient.
Definitely. Like you said before, people constantly ask, will this be getting worse? Should I stay out of the market? Should I start selling my stock? I don't want to keep losing money. And that's another thing. Maybe the assets that you have are currently losing value, but you don't actually make that real loss unless you sell your stock. That's the moment when it actually becomes a loss for you. Because I mean, yeah, you just keep that stock and maybe in a year it starts growing again, and then you didn't lose anything, or you actually gained something out of it. But like you said, don't stay out of the market. Don't just start selling because you don't want to lose more. I mean, yeah, it's something to get worried, but in the long run, having a well-structured plan will really, really help you on the bad times. If you
I agree. I think that's the price of investing in stocks. The price is, it's not always going to be uphill and always making money every day. There's going to be ups and downs, but in the long run, the stock market has shown to be a good long-term investment. I mean, historically, 1 out of every 4 years is a negative year. We've gotten used to just having positive year after positive year, but negative years will happen, and that's just the cost of being in the market. But trying to get out of the market and guess when a good time to get back in is foolish. Trying to time the market is not something you can do. And if you are out of the market, you may miss out on a lot of the recovery. So I think you have to put it a little bit in perspective too, that most up markets, most of these bull markets are longer and rise higher than these bear markets. They tend to be shorter and they don't go down as far. So, I mean, overall, the market's going to trend up. You just have to stomach going through these downturns. And that's why you need a good plan. Think of how much do you need a year? How much do you need a month? Don't put that money you're using this year in the market. The market money is long-term.
No, definitely. And like you said, maybe simple example out of it, having yourself on the market or exposing yourself on that, it's giving 3 steps forwards and 1 step backwards. Yeah, it kind of times you down, but in the end, you're moving forward anyway. And if you actually see a graph out of the S&P 500 on everything, like if you go 100 years backwards, even if there are downturns, you will always see that it's going uphill. So you need to put it like you said, it's putting it into a perspective on just enduring. That's all, and just keep investing. Especially like if the market's going down and you keep investing, you're practically investing on the discount. So it might be troublesome and difficult against some type of mentality. Like, to be honest, myself, that was something kind of hard to believe for me. Or at the beginning when I first started investing, I was like, okay, I don't feel comfortable at all putting my money, especially now if I invest like $1,000 and tomorrow or the week later I see that it's actually less than $1,000. I was always feeling like uncomfortable doing it. But like you said, when the market starts to recover, that's when you're actually seeing the good returns. Because if you try to guess it, you might miss. Even if you miss for 1 week the actual return on the market, that will, especially if you have a lot of money invested, losing just 1 week of the recovery of the market will have a real big impact on your portfolio.
Yeah, there's some statistic with the S&P 500 that if you look at 19 years or 20 years of trading, if you miss the best 20 days, your portfolio return is about 6% lower. I mean, you really can really impact your overall return if you're sitting out and missing these big jumps in the market.
Yeah,
and and I think 2 things I'd say. The market is one, forward thinking, that it's priced based on what we're expecting to happen.
Yeah.
So the market is not the economy. So the economy could feel terrible, but the market may be expecting a recovery and jump up. So it's not necessarily what's happening in the news today. The other thing I'd say is the anticipation is just priced for what we know. So unless you have some insider information or some secret, it's priced for what we know. And even if the news is saying, oh, it's going to be a recession or it's going to be horrible, well, the market is already looking at that. It's already expecting some increases in interest rates, and that's already built into the price.
Yeah, that's why they always said, like, by the time that you heard the news, or that you heard it in the news, it already happened. I mean, it's not like, oh, this is happening right now, I'm going to sell, I'm going to buy. But by the time that you already heard it on the news, it already happened. That stock that it's currently overperforming or it's doing super well, by the time that you want to invest in it, the price is already too up for you to invest in. Or it kind of the opposite as well. By the time that you heard on the news that, oh, this company is going bankrupt, and you want to get yourself out of it, by the time that you want to sell that stock, it's already worth a dime. So,
and the news too. I mean, cable news is there just to sell. I mean, they want clicks and they want viewers, and they're, smashing their whammies and saying to buy, sell, and it's entertainment. It's great, but it's not a long-term real financial plan. And so you can't be reacting to the panic on the news. I mean, the bad news sells. They're always panicked about something.
Yeah.
Here, I can show you. I don't know if this is helpful, but here's a look at the S&P 500. So I did it for the last 22 years, going back to 2000. And you can see, I mean, long term, we're up. Owning companies, being a stockholder, even if it's through exchange traded funds or mutual funds, but being an owner of companies, you get rewarded. I mean, governments want the economy to do well, wants companies to do well, and you get rewarded a lot more than if you're just lending, if you have your money in the bank or under a mattress. Yeah. The bad thing is you see these downturns, but the good thing is overall, you see a lot of good movements. So if here's a 5-year window, and you can see here was COVID. Pre-COVID, we had the dip, we had the big all-time highs at the end of 2021 and 22. 22's been miserable. But it's priced for what we know. We can't say, oh, it's definitely going down this year.
No, you're totally right. And like the other day, I believe that it was like 2 or 3 days ago, my mother-in-law, she is 52 years old. She asked me, oh, how do you actually start investing? She's kind of old school. She's like, just save up money in the bank. I kind of explained to her, like, principles of how much money you want to do you have, or how much money do you want to have by a certain amount of time. Or it's all about perspective. You need to have at least an expectation and a goal to build it up. So I try to explain to her the best that I could, and just, if you are going to need money for the next 3 years, have a budget. That budget, keep it for yourself, or at least have liquidity on it. And like for those 3 years or 5 years ahead, just put it on the market, build a diversified portfolio, and that's the best that you can do. Because if you just leave your money sitting in the bank, it won't do nothing. It will actually lose value day by day, and by the end, like if from here to 20 years, 30 years that go by, that money will be, it's not going to be worthless, but I mean, it's going to be like 1/3. It will lose 1/3 of its value. So,
you're right. The interest they pay doesn't keep up with inflation.
Yeah, it will be super bad. That's what it's better. Like, one specific thing that she told me, like, oh, it's just that I'm too old, and for my age, I cannot start investing right now. And I was like, you're never too old to start investing. It's like actually keep up with a plan. It's just have a budget, prepare yourself real well, and have a good habit of, okay, just you can really just start investing with what I just told you. Just do it, and believe me, you're not going to regret it. What you're going to regret is just having your money sitting over there in the bank. And by the time
you didn't start earlier.
Yeah, no, and definitely, because by that time you will definitely start to struggle with money. And I mean, and not just her, to everybody. And if whoever listens to us, then this is the real serious advice that we can give. Don't just let your money sit in the bank and do nothing for you.
Well, even if you look at the stock market, I know 2022 was horrible, but if you look at the market right now, and look at the last 2 years, the market's up about 2%.
Yeah.
A little more than that. Even if it had a down dip, it did have an up, an up the year before. So it's longer term, it's fine. I think you're exactly right. You want to look at what are your cash needs, keep that in safe investments. What's more long term? Do you have debt that needs paying off? Can you invest in, paying down debt or in your own business? It doesn't have to be in the market, but think of what the opportunities are. Yeah, and there's a lot. I know real estate is the popular thing to do, but it has its ups and downs too, and it's illiquid. So some in real estate's fine, but this diversifying, just to explain what that is investment. So instead of just being in the stock market, large US companies, have large US companies, but also have small, mid-sized US companies, have foreign developed companies, have companies in foreign emerging markets. Just have them in different industries, geographic diversification, industry diversification. And then when you set that target, let's say your target is I want 50% in stocks, 50% in bonds. If stocks do great, then you are selling stocks and buying bonds. If stocks do terrible, like they did last year, you're selling bonds and buying stocks while they're down and on a discount. So the rebalancing in the long run will help you sell when things are high and buy when they're low, and improve your performance and keep you in line with your goals, with your target.
Yeah, no, definitely. This is the solid plan. And to be honest, I won't call it ironclad, but yeah, it's like we go over this with each one and every one of our clients. We always develop a good financial plan to be in line with what they want to achieve and what they want to spend. That's an everyday work for us. And to be honest, and if you want to do it by yourself, that's something real good, but definitely start doing it as soon as you can. If you don't have the knowledge and you want assistance, feel free to contact us or any financial advisors. But definitely, this is something that can definitely make a difference on how you live your life on the next 10, 20, 30 years forward. And about what Bill just said, and we will be putting on the blog post of this video, we will be showing an example on why you need to have a diversified portfolio, on how the different sectors of the market perform. Even if, like Bill said, maybe one that like the big value markets perform well one year, the next year can be really not good for that, and the small companies did perform better. So we will show an example on why it's good to have a diversified portfolio. And is there anything else you want to add, Bill?
Yeah, I was just going to say that, you can't chase past returns. Like if something did well, like tech did great in 2021, it doesn't mean dump all your money there. It just did great. That's actually when you should be selling. If it's outperforming the average of your portfolio, But I think too, we do have a lot of clients who it would be nice if investing were more fun and we could tell you, oh, this is what you should do. We don't have a crystal ball. It would also be nice if it never lost money, but that is the cost of being in the market and getting all those double-digit returns for the last 10 years.
Yeah.
And so I think, just like you said, if you have a plan in place and you can go back to that plan and say, all right, here's where I want to be in 20 years. Here's where I am. And just be in the long term. That's what we look at, the long-term financial plan. And I think that gives clients comfort that even though the market lost money in 2022, you're still on track to retire in 10 years, or you're on track to meet your spending needs in retirement, because we've put a plan in place ahead of time.
Yeah, definitely.
Reacting.
Yeah, and it's definitely not, it's like you said, the investment doesn't really need to be super exciting. It's something boring, because it's actually needs to be done with time, carefully, and just on slow pace, because that's a better way to get something out of it. So don't try to guess anything on the market. And definitely don't try day trading, because if you have luck one day doesn't mean that you will have luck the next time. So yeah, having a boring but slow paced financial plan, it's the best thing that can be done.
And in the earlier you start, the better. Don't wait for good news. Don't wait for, I have this money, but I'm waiting for the economy to turn around before I start investing. Just get in there, just contribute regularly, start investing, get a plan together. It's not going to be fun. 2022 was terrible. Every time you looked at your account, every month it seemed to be going down. So it's some years are not going to be fun, but in the long run, that's how you meet your goals, is get in there, get investing, start saving.
Yeah, now that the market's going down, just max out your Roth account. So.
Yeah. Buy while it's on a discount there.
Yeah.
On sale.
Yeah. Oh, I think that was it, right?
That's all I got. Yep. Sounds great.
Okay, definitely. We are AIO Financial. Feel free to reach out to us. Any type of comment or suggestion, we will gladly hear or read it. Feel free to reach out to us, and thanks for the time.
Yeah, thanks for your time. Take care.
Bye.